You need to understand this before you ever raise a dollar of capital. My name is Mac Lackey. I'm a 6-Exit founder, mentor to entrepreneurs all over the world. And one of the things that I learned the hard way is that raising capital changes everything. Now, a lot of entrepreneurs believe that the steps to creating a scalable and successful company, maybe having a life-changing exit, is have an idea, raise capital, scale the business, and then ultimately sell it or do something down the line. That is not necessarily a 1, 2, 3 strategy. And one of the things that you need to understand is that when you raise outside capital, whether that's institutional capital, private equity, venture capital, angel capital, even friends and family, is that those investors have expectations. The more institutional or the more formal they are, so think venture capital, private equity, etc., they have very specific expectations in terms of returns on capital. So if you start a business, maybe that business is worth $1 million. It's starting to have some early success. Maybe it's worth $2 million. And you decide to raise a few $1,000,000 in venture capital. You get an offer to sell your business for $5 million or $10 million. You are high-fiving yourself and everyone around you thinking you have arrived. You're about to make millions and millions of dollars. The reality is those investors might well prevent you from selling and saying they expect a 10x return on their investment. So if they gave you a few $1,000,000, they may need you to sell it for 25, 30, or even 50 million. And in many cases, those investors have already decided it's okay to get a zero. They would almost rather you not sell the business, get nothing in return, because they know across their portfolio where they make 10 investments, one of the companies is going to sell for 100x, and that's how they're going to make the return. So you need to understand this dynamic. One of my companies many years ago, we got a term sheet from Chase in New York. It was March of 2000. We were going to raise $15 million. The dot-com bubble burst. And in that moment, something really fortunate happened for us, which is despite all the chaos around us, we did not take their capital. We decided not to take the money. They were changing terms on us. Very long story short, we decided to sell the company. We sold the business for about $15 million. My partners and I split the money, millions of dollars. It was my second exit. I was still in my 20s. But if I would have taken the term sheet from Chase, I would have had to grow the company to probably over $100 million to make the same amount of money that I personally made by selling it for $15 million that day. So just understand that when you bring on capital, you are resetting your timeline, you're resetting the expectations, and in some cases, you have handed over the rights, the preferences, and the terms to other investors. Now, I want to be clear, not all investors are bad. I'm not even trying to imply that. I think strategically, sometimes it makes enormous sense to raise money if your plan is to 10x, 15x, 50x your business and you have a long time horizon. But if you're an early stage high growth entrepreneur and you hope to sell your business for life-changing money for you, maybe at 5 million or 10 million or even $20 million, the fact that you have investors can really change that dynamic. So do it with open eyes. Working with one of our members right now, they were in the middle of raising capital. We had this discussion. It changed everything. They decided to go back, really think about going to market and selling the business today. So again, just eyes wide open. If you raise capital, it resets timelines, expectations, and so many other things. If you need help, we're always here. Respond to this message with Elite. We'll see if it's a fit. We do coaching for entrepreneurs all over the world, including like this: when, how, where to raise capital so that it achieves your goals and dreams.